Good morning and welcome to today's webinar from the People's Pension supported by Defaqto. Today we're looking at pension default funds in the light of Defaqto's new report analysing workplace pension default funds. First, a little about the People's Pension. In case you don't know, the People's Pension is a not-for-profit master trust with more than 4 million members, making us the biggest master trust in the UK which isn't owned by the government. Without any further ado, I'm going to ask David Cartwright, who's with us from Defaqto, and Nico Aspinall, the Chief Investment Officer from the People's Pension. Welcome to both of you.
Morning.
Good morning.
David, can you kick us off with the highlights from this really interesting new report from Defaqto on default funds?
Yes, we've just released the guide, the report, about 2 weeks ago, with the central focus on the performance of default funds. Within this, we do look at governance and regulation on that particular subject within the audience, and we asked the whole market invited them to participate in this survey. This market splits into two in one way. There's the master trust regime and there's the contract-based schemes, trustees having the governance with the master trust regime, and then the investment government committees and through the contract-based schemes. So those highlights were governance, investment management. We looked at some of the benchmarking, some of the costs, and of course the investment performance at the core of this.
Thank you, David. Governance I think we'll come on to because obviously it's critical. Nico, take us onto that terrain right away. How does the People's Pension, you're the Chief Investment Officer, you're working very closely in partnership with the trustees who run the pension scheme on the behalf of our members. How does the People's Pension approach its investment job, default fund investing?
Well, I think the first thing to say is that we see it as the most important job, the default. So 98.7% of our members invest in the default. So making sure that delivers good returns ahead of inflation. So inflation ultimately, that means that a member's contributions are worth more to them in retirement than they were when they were taken from their pay packet. So returns ahead of inflation is really important.
So that's the long-term, sorry to interrupt there,
Yeah.
so our the long-term objective is to deliver a return bigger than inflation over the lifetime of a People's Pension member investing with us.
That's right. So over the last 5 years, we've returned about 8% ahead of inflation for the core default accumulation building block.
Every year over the last 5 years?
Well, on average over that time. So if you'd put £1 in 5 years ago, it's now worth about £1.52. So, that's a fantastic kind of proof point. No, so not quite, right? So the long term is a lot longer than 5 years.
And the past is no guide to the future.
And the past is no guide to the future. I think it's really important that we make sure that the investment is cost effective. That's the kind of first kind of free return, is making sure that you don't waste money on investments. So a part of that, you'll have seen our recent announcements to reduce the AMC that we charge members, so that, and quite distinctly I think in the market, the more an individual saves, the lower the AMC is charged on their pots. So later in the year, essentially that tiers down. If you have more than £50,000 in your pots, then it's 20 basis points, so 0.2% per annum charges for the amount above that.
Which is really quite striking, a departure from where the market currently stands in charges, but we'll come to that.
Yeah, and I think it's a really important proof point of what you were saying earlier about us being not-for-profit. So, we're not incentivized to kind of maintain a high charging level so that we can return money in dividends to shareholders.
And we're not thinking about building a helipad on the roof of our Crawley HQ, so the money has to go back to members one way or another.
Correct. And then as you mentioned, it's about the relationship with the trustees, the partnership there, working with them to say, well, what does the long term look like? And a part of that is responsible investment as well, investing responsibly.
So let's hold that thought on long-term investing, responsible investment. I think it's really striking. We'll come to that in a moment. David, some of the assumptions you use in your report, so you looked at 23 providers as I understand it, or there was 23?
We invited all the schemes on our table. We invited nearly 70 schemes from about 35 providers to participate in the study, and we've got 23 participants in the study.
So 23 agreed to participate, and you've got that quite rich data set.
Yes.
What would you say about the report? Has anything surprised you as you worked through the report?
This is now our third year in this report. I think a variety of, we've looked at, in the core part of the report, we've looked at both nominal fund performance, actual total fund performance, but we've also looked at risk adjusted. So the relationships there are different, but there is quite a divergence in performance, possibly partly driven by the fact the asset allocations and the use of different types of asset is quite varied. So that's an observation from us as a research business.
How big, David? How big is the dispersion of returns?
That dispersion is nearly 4% on a total return if you take average over 5 years, and we captured these prices at the end of 2018. So that would have been that point. So I guess from our findings, sorry, Gregg, I was saying benchmarking differs in the market, and that may have an impact on total returns, because as Nico just alluded to, some are using inflation or CPI plus as a benchmark, others are using cash, or maybe the ABI mixed sectors, typically the sort of 40 to 85% where you've got a balance of assets.
That 4% is a big range, right? But I think, and if you extrapolate that out to retirement, that's really the difference between kind of wealth and poverty in retirement. But I think it's also important that advisors kind of look a little bit under the hood of that and think about kind of what's going on in the asset allocation, but not to treat that as a snapshot, but to focus on the governance. Who's in charge of this? Who's looking after this? How is this evolving over time?
Nico, the 4%, you said something really striking there, that's the difference extrapolated over the long term between, affluence and poverty in retirement. I mean, 4% a year over 40 years is going to make an enormous difference if we just use that as a measure, isn't it?
Yeah, it really is. I mean, look, the compounding of that kind of gap, just means that you keep on falling behind, essentially.
I think, to give this balance in our guide as well, I think, we have got the risk-adjusted figures based on Sharpe ratio, total volatility and Sortino. So that gives a bit of balance in the guide.
And let's come to that, the risk-adjusted. But first, let's say a little more about asset allocation. So that you found in the report, David, I think I'm saying there are, there's inevitably there are different approaches to asset allocation. Some funds have higher equity contents, some funds have lower equity contents, some funds have property and alternative investments, some funds don't.
Yes.
Nico, the People's Pensions approach to asset allocation in the default fund, how would you characterise it?
Yeah, so, look, we're seeking diversification. So we have property, infrastructure, we have a global bond portfolio, the sort of traditional developed equities, so the US, UK, European, Japanese, but we also have emerging market equities. And then recently we also introduced factor investing, which is a kind of technique which sits somewhere between kind of what would be traditionally called passive and active. So trying to use data to essentially to beat markets over the long term.
So let's just take that a bit further, really striking. So the asset allocation, what percentage of the People's Pension Default Fund is in what would be known as growth assets, and what is in defensive assets, equity, bonds, property?
Yeah. So look. So the growth assets. So when you're a default investor and you're young, so 80% of your money is going into growth assets. So that's the equities, the properties, the infrastructure, and 20% is going into more defensive. So it's a fixed income. That's the bonds, and about half of that is UK, and the rest is a global bond portfolio.
And is the idea that is the growth assets in periods when they are performing less well, that the fixed income will compensate for that?
Well, that's the hope. Since the financial crisis, maybe that old sort of truism of markets hasn't been quite so true, but certainly they move less. So it certainly is still defensive in terms of if there was to be a market correction, and over the last few days we've seen a bit of that. Ideally the bonds, increase in value in that, and certainly in the last few days that's kind of been the case. But if you go into other of the various kind of market movements we've seen over the last 10 years, then they sometimes move together.
And that asset allocation reflects that long-term objective of outperforming inflation.
That's right.
Is that right?
Yeah. So look, you have to take risk in your portfolio to get returns. actually in the modern world, cash returns less than inflation, so you can't, there's kind of no zero risk position that is acceptable. If we invested in cash for 40 years, then actually you're just eroding the spending power of the money. So you have to take some risk, and then really the diversification, having lots of different asset classes, markets, ways of structuring your access to that, is about trying to make sure that you have different returns in the portfolio in different market scenarios.
And I want to come back in a moment and ask about cost and how central that is or otherwise to your investment philosophy. But David, picking up on the risk-adjusted aspect of the report, can you say a little about the assumptions that you deployed, say, on the risk-free rate of return and so on to measure risk-adjusted returns?
Yeah, sure, and I think Nico alluded to this on the differing benchmarks used in the market, cash plus, inflation plus, ABI, Investment Association benchmark. Yeah, we used a risk-free rate of 0.75%, so that's commensurate, I guess, with the base rate. Yep. So we've used that as our risk-free rate, and the risk-adjusted returns have been calculated against that.
So basically, what has been generated beyond the risk-free rate of return?
Absolutely, yeah. There's a good comparison then with the total nominal returns that are also held in the guide as well. Yes.
And if we take a moment to take it beyond the numbers and returns and then into Sharpe and Sortino ratios, can you say a little for the advisor audience? And please, advisors, we're delighted to receive your questions as we go. Any questions will be answered as fully as possible. How should we think about the importance of Sharpe ratio and Sortino ratio, Nico?
Yeah, well look, so maybe to explain those numbers, essentially the Sharpe ratio looks at the volatility of the portfolio and essentially says, does that achieve return? So volatility as a measure of risk, and we'll maybe come back to different ways of thinking about risk. But if your portfolio is going up and down, it should be offering you some long-term return. So the Sharpe ratio is looking at the ratio of that kind of long-term return and the volatility of the portfolio. And the Sortino is saying, essentially, it doesn't really matter if my asset is volatile but going up in price, that's actually good news, and I don't care. But if it's volatile and it's going down in price, then that's something to measure. So the Sortino ratio is looking at the sort of the downside half of that Sharpe piece.
And that's people worry about the downside in particular, don't they?
Yeah, so both. I'd see both as being important. Ultimately, the volatility. We've got 4.5 million members, so we have people coming in and out of funds all the time, and volatility is still a half downward movement. So things are going up and down. That's what creates volatility. So it's important that when we think about asset allocation, when we're looking at new ideas to put into the portfolio, the kind of proof statement to us, which gets the trustees comfortable that it should come in, is to say, if we're going to change the risk of the portfolio, then it should be to achieve return, or indeed, if we're going to put something in, then it should be obvious that it's going to reduce the risk but maintain the return. So the things like the Sharpe ratio are important in terms of saying, we want to spend more money on a particular asset class, or we want to take some money out of an asset class and put it elsewhere. How is the Sharpe ratio expected to change in the future?
And I'll come on to that issue of how we approach risk going forward more in a moment. David, the advisors watching, what would you say are the factors used in the broadest sense which should be considered when assessing default funds in a comparative way? Is it governance? Is it investment philosophy? Is it cost? Obviously, they're all important.
Yeah. I think they're all important. All probably have different weightings in slightly different scenarios. We've covered performance in this and risk-adjusted performance and the risk premium, risk-free rate we've just alluded to. One of the fixed items, I guess, is charges, because charges can vary. So over the long term, charges can have an impact. But I think quite rightly, the regulator has said that value for money in a workplace environment is not just cost or price. It's a total thing, but clearly charges.
And is that because of the compounding? Is that what seems a very small number as a fraction of a percentage over 40 or 45 years of saving and investing?
Well, naturally, I think, Greg, yes, over the longer term, a charge can have a large impact if you're in a fund for 25, 35, 40 years. That certainly has a compounding effect. Governance, we've mentioned, is a factor we picked up in our guide as as being important, and clearly the governance structures sat over the two types of scheme in the market vary somewhat for contract-based schemes and trust-based schemes.
What is the difference? How would you characterise the difference between?
I think with the trust-based schemes, you've clearly got a governance structure whereby trustees are responsible, and those trustees have a very close relationship with the scheme, the provider, the investment manager, the chief investment officer, etc. And really, with the contract-based schemes, you've got a more independent investment governance committee, whereby you've typically in that environment got funds or listed funds being managed with some independent members on an investment governance committee, but probably they are overseeing and not as hands-on involved as would be in the trust.
Yeah, so they're kind of advising, whereas the trustees are making the decisions. It's
to a degree, yes.
It's that sort of distinction. So that's something worth considering, is the different approaches to governance. Advisors, what are you most comfortable with?
The other part was we covered part was sort of asset allocation, the approach to asset allocation, the use of active assets, actively managed assets, passive assets. We've captured that information in the guide as well, how that's employed. Yeah. So all of those factors contribute to the outcomes on risk-adjusted performance that we've captured in this year's guide.
Thank you, David. So let's take that up, Nico.
Yeah, I'll just come back to that sort of governance question, really, which is that it's important when you look at our current asset allocation, as that pie chart, to realise that is not going to be the same for the rest of all time, right? So my team working with the trustees, raise new ideas, looking at performance of different asset classes, looking at markets, trying to say, actually, how do we make sure that we're kind of keeping this up to date? And all trust-based schemes, I think, as an advisor, I'd be looking for a proof point which says, if I go back 4 years or longer, or, how has the asset allocation changed over time? And with us, you will see a large amount of difference, and we'll maybe come back to that. With the insurance-based schemes, first off, the IGC is not making decisions there, right? So they're reviewing rear-view mirror the decisions that were made by the provider. And you may well find, partly because of the sort of for-profit status and partly for the sort of governance reasons, that there's less incentive for them to change things over time. So, that's maybe slightly kind of a cruel way to put it, but if you look under the hood, you may well find that there's a multi-asset fund and there's a fund manager, a portfolio manager in charge of that, and things are changing. But that kind of top line, what does the pie chart look like for a member at a particular age? That may well not change, or indeed never change.
And how has our asset allocation changed in people's pension over the last few years?
Sure. So, really the kind of big pieces that we achieved over the last year or so were to put in property, the multi-asset infrastructure fund, emerging market equities. We put in place diversified the bond fund, so it was very much a UK portfolio. It's now a global and UK portfolio. And then from December last year, we have been slowly building up over time a factor-based approach. So we're able to do that again in the trust-based environment because the overall benchmark, is a sort of guide. It's not actually the objective. The objective is to meet inflation or to beat inflation over the long term. So we're able to use contribution flows to build up a holding in a multi-factor approach over time. That saves transaction costs. Again, cost discipline. We don't want to just waste members' money selling stuff and buying stuff if we can just use contributions to change the pie chart over time.
And that attitude to cost, how does your view of cost as a chief investment officer affect your broader investment philosophy? How is it related to your broader investment philosophy?
Well, look, I think it introduces. So I think the first thing is that the view on cost is let's not waste money, right? So this is our members' money. It's really important that we can justify any new costs that we're putting into the portfolio. So that's I think the first thing. The second bit is really to introduce a bit of cynicism around active management. So active management is a lot more expensive than passive management. That's a feature of scale. So generally you're making smaller kind of bets with an active manager, and potentially you're splitting those bets between lots of different active managers. And that kind of sheds your pot, you know, however big you are, we're £6.5 billion now. You're diluting your purchasing power in the market, you know, by going to multiple active managers. And of course, you're also potentially buying mechanisms where costs are less transparent, let's put it that way. So active management has had a very poor run, you know, since the financial crisis, since 2008-9 or so. Active managers have really struggled en masse to kind of beat markets, but we're also kind of concerned that they don't serve the needs of the client very well. They're expensive for no good reason. And you know, the sort of they don't really take the risks on those costs in the same way that the investor does. So we have a cynicism towards active management. I don't think we're saying that it's bad and that we would never do it, but we've got to do it at the right price in the right way.
Very useful, and also the distinction, am I right in saying, between sometimes there's a blurriness between passive as an implementation tool and of course the active asset allocation which you and your team in partnership with the trustees are making.
Yeah, so I would make a distinction between, I guess, a data-driven, what the market would normally call like a systematic approach, where we say, look, there's a computer that tells us what to invest in, and that constructs some sort of index, versus human discretion, where I've got analysts reading reports, people meeting the CEO, CFO to say how well are you doing. That's the active side. I think this sort of third way is emerging, where a lot of the techniques that active managers would use can be written as analysis, can be written as data-driven systematic investing, and that's the factor investing piece.
So basically, you get the advantages of active via machine learning, but the much lower cost.
Yeah, and if you look, so DB's got there kind of already, big institutional sort of sovereign wealth funds around the world. So really, the Norway kind of sovereign wealth fund discovered this technique, which says a lot of what active managers claim is essentially the intelligence of a human is really the intelligence of reading data. And actually we can take that data reading piece away from those humans and put it into a spreadsheet, and we'll get almost all of the returns captured. That doesn't mean that the active guys are not doing anything beyond that, because they are doing subjective things. The qualitative pieces, they're meeting the company, they're sniffing the company. I think that's important to note. But they were taking a lot of credit for stuff that actually now we can put into a spreadsheet.
Very interesting, Nico. We'll take this further in a moment. David, what the report found in terms of default funds, passive versus active, is it all passive now in default funds? What did you find?
No, that was an interesting one. That has moved as we've been producing this guide over the last 2 or 3 years now. There is more of a move towards passive, and there's at least a passive element on the basis of what Nico has just really alluded to in most of the default funds, but there are still about a third where an actively managed fund is employed, or an actively managed strategy. So there is definitely a balance in there, but we have seen a shift over the last 2 or 3 years. Yeah,
and I think
as we produce this,
it's difficult, almost as an outsider, or with a kind of survey to fill in to understand where that active is happening. Yeah. So it could be that the asset allocation itself is being actively managed, which means kind of swinging stuff around a lot potentially. Maybe trying to react to market events, something like Brexit, the US-China trade wars. You could have a hypothesis as to how to deliver value to a member in the asset allocation overall. Or it could be that you're saying, hey, we have the insight better than the FTSE 100 as to how to make returns from the UK stock market, and don't focus on all 100 of those shares, have these ones in.
That's a bold claim indeed. Advisors, just to reiterate, questions are welcome through your device. We'll be delighted to answer any questions we have coming through. In the meantime, I want to take further, really striking. So I would have expected that default funds had gone entirely passive now, just because of the cost involved, the increasing evidence of cost being a drag on returns, and the poor performance of active management over the last decade. Nico, taking that further, but slightly differently, how would you think about the future approach that the People's Pension is likely to take? It's clear that you favour passive implementation with an active asset allocation. You don't rule out active management where you think it makes sense at the right price in the future. Yeah. Well, we hear a lot now about illiquid assets, that the way to get really good returns, risk adjusted over the long term, is to have a greater allocation to those illiquids to capture what's known as the illiquidity premium, real or phantom. But to be fair, certainly in Australia, there's been lots of evidence that funds like ourselves, not-for-profit funds, have done very well from large allocations to illiquid assets. Do you see that as an avenue which the People's Pension is likely to explore long-term, and if so, how?
I do. So can I just correct one piece? So I wouldn't position ourselves as being an active asset allocator. So I think, you know, we are willing to change asset allocation over time, but that's very much what I think the market would frame as a strategic asset allocation approach. We think that real assets, so physical buildings, infrastructure projects, unlisted assets, so looking away from the big corporations who manage to get listings, down into to smaller businesses, we think there's lots of returns to be offered to members there. And of course that's actually, turning ourselves around and saying, well, actually investment is a part of society. Members save capital away from their paycheck. We should deploy that capital into growing the economy.
And these would be known as active. This would be active.
Yeah,
assets,
there's no way to do it kind of traditional passive.
Because really good questions came in from Richard Hawkins. Hi, Richard. Thanks for watching. Really asking, is there not a question if you're focused on passive that you're reducing the range of assets that one can invest in?
Sure.
Illiquid assets are active in that sense, aren't they?
Yeah, I mean, so I try not to get too hung up on the active versus passive piece. So I think there's listed and unlisted. I think that's maybe a better distinction. And then, as I said, there's sort of systematic. So can we use spreadsheets to approach really listed markets or human discretion? And I think it's man and machine, not man or machine. I think that's where you've got to get to. And yes, absolutely. I think our first piece has to be to say that we could invest in every asset class that's available and kind of rule it in or out for reasons of what it's going to do to the portfolio. So I think in time, having unlisted assets into the portfolio will absolutely be a part of what we're looking at. They are more expensive to manage. So there's a question of how big, how much scale we can bring and whether that drives down the cost. And essentially at this point, it would be adding, it'd probably blow us through the charge cap type additional cost for us to do a substantial allocation.
And it's worth mentioning that scale, Nico. So we're sitting around £6.5 billion in AUM at the moment. Reasonably, where would one expect the assets under management, the People's Pension, to be in, say, 5 years, 10 years?
I think the latest internal projection I was looking at was something like 20 billion in 2025 and 50 billion in 2030.
That's quite a lot of muscle, isn't it?
Yeah, it's kind of good walking around money, right? So, and actually plausibly, there's a lot of discussion about the consolidation of the market. It could be higher than both of those.
And the greater assets under management, I assume the easier it is to really get value for money when.
Yeah, so if I was thinking about private equity, so private equity is essentially a process of looking for companies that maybe need a different approach, taking them so that the company takes whole ownership of them, potentially changing the team or merging them with other companies, or essentially reinvigorating that business, and then aiming to kind of do that, put that back into the markets at some point in the future. That traditionally charges 2 and 20, so 2% per annum and 20% of the performance. That's a huge amount of money, and the reason they're able
the
to
charge cap is 0.75%.
Correct. Yeah. So when you come to that market with £100 million, which feels like a lot of money to us, but in that scheme of things, it's not that much. Then they say no, it's 2 and 20. You can just take your line in the queue. When you go with £10 billion. Actually, you have a very different meeting with them, and we can structure that. We have the negotiating.
It's like buying anything, right? The more money you can bring to the table, the better price you can strike.
Yeah.
David, does the report touch on any of these asset allocation?
Yeah, we do, and we haven't actually put the specific asset allocations in the report. But what we have tried to do, hopefully for advisors, is to list the key asset classes used. And we appreciate there may be sub-asset classes beneath those, such as the detail Nico has just covered. But we've got, of the 23 that have participated in the study, around 10 use property as an asset class. About 8 use alternative investment strategies, and that could be a variety, I guess, from private equity to long and short investing and other mechanisms. Debt, yes. Commodities are used by about 5, so commodities as a diversifier. Cash is used as an asset class by some, and understandably fixed income is used by 18 of the 23, with the equity class used across the board. So it's quite interesting for us capturing this information that there is quite a variety of strategies used for asset allocation against what we've classified as this mid-growth phase.
Very striking. You mentioned there, David, commodities, which brings me on to an issue I think we need to discuss in some detail, which is the way in which pension funds are approaching these growing issues of responsible investing, sustainability, climate change, environmental, social and governance approaches, ESGs, it's known more broadly. Commodities, Nico, is that something we invest in or are likely to invest in, and if so, why? If not, why not?
Yeah, so it's not something we do at the moment. For me, actually, I'd say the kind of case is out on commodities, and that's, I won't get you too drawn into like an economic discussion, but there's like a stock and flow type piece. So do I own the grocers, or do I own the apples that I sell to the grocers? And you can argue you should have both, or you can argue you can have one. I think commodities is a really difficult asset class because basically they're synthetic. So no one ever has oil tanks like hidden in the background, right? No one has a safe with gold in. They have derivatives based on those assets, which means that you're not actually investing fundamentally in the commodity, you're investing in the movement of the price of the commodity. So there's various ways to do it still. So you could invest in the company that mines the ore or the company that kind of pumps the oil, and we will do that. So if you look in our portfolio, essentially, those kind of mining companies, commodities companies are in there. But kind of calling it out as a separate asset class is not something we do at this point.
And very striking, that takes us into that broader issue of responsible investing.
Yeah.
How would you characterise the People's Pension's current approach,
sure,
and where you in partnership with the trustees want to take our approach,
sure,
in the long term? And I guess, is it right to frame it as it's about long-term investment, it's about stewardship, it's about sustainability? What does that mean to you as the CIO of the People's Pension?
Well, look, I think, personally, I think it's vital that we kind of break the link between a very short-term, news-driven kind of view of investing, with people with Bloomberg tickers, showing us movements of prices all the time, to think ahead and say, well, we've got to do this job over 40, 50, 60 years. What does the economy look like then? So responsible investing is part of a data set which can help us analyse that. So I think the first thing to say is this is not ethics. So we're not here to make investments that make us feel good about stuff. We're here to make money for members. So, the core example would be climate change. The International Panel on Climate Change in the UK, the Committee for Climate Change, the government, both parties have had governments which have accepted the climate change sort of facts.
Climate change is a reality. We know it's happening. Yeah. What is our job as a pension fund with that long-term view? Would a way to put it be, there's not much point in getting great returns if they're in assets which choke the planet, because your members aren't there to benefit from them?
I put it slightly differently, which is that, so I might get great returns from an asset class for 5 years and then it's valueless. So if I have a coal mine, that can be super profitable. I can make 20% dividends on that coal mine for 3 years, but then I find that I've lost £10 billion because that coal mine no longer has any clients. So actually, if you think in 10 years hence, and I think that would be a big criticism actually of our industry, if you think out 10 years, then really this country, we did a week and a half basically without coal in this country the other day. The National Grid was kind of tweeting about that. We don't think thermal coal has a long-term future. So getting the data, finding ways to say, well, what of these data points do we think will not be a part of that economy? That's the approach we'll be looking at for ESG. So ESG is environmental, social, governance. So there's a whole kind of slew of different issues. It's not just climate change. It could be, hey, if you don't pay your workforce appropriately, then you won't have customers for your products. If you neglect shareholders in the way that you approach your business, then you'll find that the shareholder voice, which can be very helpful for a company to access, is lost, and it means that the company goes off into a world which...
And this is where the social and the governance comes in alongside the, the environmental. David, are you seeing a trend? Is there any sign of this happening more broadly in the default fund space?
There is a trend, and it's a sort of declared trend over the last 2 years. We've covered part of this in the guide on what the declared strategy from the managers and providers in the ESG environment, and probably going back only about 2 years, it would have been a small handful who would have come back to us and actually declared a strategy for environmental, social and governance. Whereas now, if we look at the report, most managers, most providers have come back with some form of statement. Some have gone further than others. Some have actually said, well, actually, we nominally allocate an ESG rating to the fund managers that we assess. I think it's with this label of ESG, it's sometimes we get confused between avoiding ammunition and tobacco businesses and how close the proximity of the fund manager to the actual businesses themselves influencing the actual way the businesses are behaving. Carbon emissions, etc.
And that leads into a question. Apologies for not taking more questions. I found the discussion very interesting, but I'm going to take this question because it's really pertains to this point exactly. Does the People's Pension have a position on actively exercising shareholder voting rights? Nico?
So we do. So essentially, we invest through State Street. So all of our money goes through the State Street Life Company. So that at this point means that they actually hold those votes. And what we do is sit down with them, and we did our meeting just the other day to say, so what themes should you be engaging with companies on? How should you be voting on key issues? For various kind of financial regulatory reasons, they can't tell us in advance how they're going to vote, but we can tell them how we would like them to vote in advance. So we do those things. Over time, I think you'll see us bring the securities, bring the shares out of those life company portfolios into segregated accounts, which means that the trust themselves owns them, and then we will appoint someone to go and vote for those on those.
So the People's Pension trustee will have a voting card at AGMs going forward, exercising directly.
Yeah, and engaging. So it's not just voting. You know, voting. There has to be essentially something to vote on. Right, so there's how do you engage with the other shareholders to make sure that the votes are on the right issues, and there's been a lot of the kind of responsible investment work has been on that. So topics like proxy votes, topics like getting the right shareholder resolutions on the incentives for management. Though all of those topics require collaboration on the institutional investment side. But then also sitting down with the CEOs of the companies and engaging and sitting down and saying, look, these are the kind of things we like about you. These are the things that we dislike about you. Ultimately, if you persist in doing the things we dislike, then because of our ESG process, we will see you as being someone who's going to lose the value of our members. And actually, that's something that we should take our money away from. So we're not quite there yet. We've got some evolution to kind of come there, but we've got definite plans to go in that direction.
Very interesting. We've got 5 or 6 minutes left. I wanted to just take us somewhere a bit different but related, of course. Members, you know, the growth of default funds has been related, you know, very closely to the rise of auto-enrolment. So we now have 10 million people using the auto-enrolment. 99% of those are in the default fund, give or take, you know, a handful of people. What do we think members want from their pension default fund?
Where do you want to go first?
I'll take initially, Greg. I guess where this comes from is that there's not a default option. Many parts of the population, I need 10 million people have enrolled into auto-enrolment consciously, and it looks like it's been positively embraced. And then the other decision is, where do you invest your money, and the default proposition is there to provide a suitable home for long-term investment. So Greg, could you just remind me, apologies on...
No, so I'll take Nico.
Sure,
I mean,
sorry,
absolutely fine. I'm thinking, Nico, how do you think about your job and its relationship to our members?
Sure. Well, look, I think members want to know that they're being looked after without having to know the details. So, the vast majority of people didn't choose a default; they were put into one by their employer, and the people on this webinar will have been delivering the advice to the employer as to how to pick that default. And then, essentially, they want to sleep at night knowing that we're working hard on their behalves to go and deliver the pension that their savings are building up to. So I think that takes in quite a few of the different features we've been talking about. So making sure that we are thinking about the asset allocation, that we are thinking about responsible investment. I think members do have a desire to be responsible investors. That's a huge, we've got 4.5 million members. There's going to be a divergence of views as to what exactly that means. But they do want to know that people are talking to the companies that they invest in, that they're doing that voting that the question was about, that they care about climate change, not because we're tree huggers and that we're a charity to throw our money down the drain, but because in 10 years' time, actually the economy will have transformed, and we should get ahead of that curve. Because if you hire people like me and my team to think about it, we're doing a job that most people, either couldn't or shouldn't do, right? So we're in a position to go and talk to the companies about where they may be in 10 years' time, and members, just don't have that power. So you're kind of hiring someone to go and, aggregate that power on your behalf and think about the future in a sensible way.
Very interesting. Final thoughts?
I'd agree with that, and part of our guide is captured sort of risk-adjusted performance, and that is part of a long-term story, because consumers will want to be comfortable that their money is being managed properly, and it's part of the sort of social infrastructure of the UK. Actually, the actual scale of these the funds now that you mentioned earlier, Nico. So
does that take us back to governance?
Yeah, absolutely it does. Yeah. And it's I think it's really important to remember that a trust-based, master trust is going to evolve as it grows in scale, because the trustees are liable, they're personally responsible, and they're making these decisions. So as we've gone from, below $1 billion to 6 billion, the nature of what we're talking about with the trustees has changed, and you've seen that come into the portfolio. As we start to hit 10 billion, 20 billion, whatever the numbers are, you're going to see that relationship kind of go even further. And you mentioned the Aussies previously in terms of infrastructure. The super trusts over there are kind of that sort of 20 billion type scale. They're doing a lot more work in relationship with the trustees. When you kind of start to talk about the 100 billion, 200 billion pound institutions, the involvement, the kind of professionalism of the organisation, that's kind of light years away from where the UK industry is. And we're looking at those institutions, those global peers, as we see them. That's a peer group that we're joining to learn the lessons, to understand how they're putting in place governance, which means that they deliver value for the investments that they have. And that's a really important feature of the trust-based side.
And it's striking, isn't it? Auto-enrolment, it appears part of the furniture now, but it's only been in place since 2012 in its very early stages.
With 10 million people enrolled, yes.
Yeah. So it's growing fast. The People's Pensions projected AUM reflects that. Other master trusts too. On the contract side, the GPPs, are very big organisations. David, last word to you. Do you expect to see anything different? Maybe this is an unfair question. Will you be doing this report again next year?
Well, we would hope to, and we've seen some interesting trends in the last 3 years that we've generated this report. And as we've just mentioned, asset allocations have changed, the view on ESG has changed, and it is definitely a changing market across both trust-based and contract-based providers. Yes.
And of course, the assets are all other things being equal, just going to keep growing. to Nico's point, the largest pension funds are increasingly looking globally to look at peers across the world who have that scale already. And it's a very exciting place to be in some ways.
It is, and contribution rates have increased again last month. So yeah, the new money flows into these schemes has significantly increased as the contribution rates have moved up in the last 3 years.
Nico, any last words? Last 30 seconds.
Well, look, I think, as an advisor looking at auto-enrolment providers, I think I would distinguish between, we talked about the contract-based and the master trust-based. I think that is a big distinction. And then I would also look at just the scale of the master trust. So I do think that the bigger master trusts are more able to evolve into the future. I think that gives you a certain kind of capacity to do that. And then, I'd look at our charges, the charges of the sector. I think what we've done as a not-for-profit, to make a statement which says we shouldn't kind of maintain a charging level, we should be dropping that as your pot grows, I think is distinctive and is a really important part of the analysis an advisor would be doing.
Thank you, Nico. Food for thought. David, thank you too. Thank you to all those watching today. I've certainly enjoyed it. I hope you found it interesting, and goodbye.